Welcome to Markets Now. I'm Michelle Rourke with John Payne with Advanced Trading, and grains are trying to push higher this morning with the exception of Kansas City or HRW wheat. And we are seeing the livestock futures trying to trade higher as well. And John, and it has been a train wreck, especially yesterday. We saw new contract lows, and I think all three wheat exchanges in soybeans. And the funds have been pressing the sell side. We're seeing a little bounce, but it's just really corrective in nature, isn't it? Just because we're oversold.
It's been a really ugly last 15 days, and it was ugly before that, but we saw a little reprieve for the acreage report. And then following that, I think it's just been kind of an easy sell. And I use that in air quotes, for folks who just want to go in and sell the board and try to shed risk in the easiest way possible. And so between that, you've got, the higher acreage that we're getting out of Brazil. That's the new kind of theme. I think that folks are going to start to kind of gleam onto for 2024, 2025 is that, low prices should cure low prices by supply coming down. But if you're not going to cut acreage in Brazil, it's going up in Brazil. It's hard to make the case that's happening yet, at least from a global perspective. So, the conditions here in the U.S. are ripe. They're very good. I'm speaking to you on the 16th here, the Monday or the morning after a pretty heavy storm in the the northern part of Illinois. But from what we've heard, the fallout is really more minimal, located more Chicagoland, the city, urban areas, not like in 2020 where the derecho hit, mainly row crop storage areas and things like that. So we might have dodged a bullet in regards to those storms last night. And I just think the market has a very difficult time getting bullish on, anything at this point, outside the fact everybody's bearish, and that might be what it takes.
Yeah, sometimes if you get the market leaning all one way, sometimes you can see the contrarians win on that. But, right now we just have not had any weather risk. And really, when you look, the market mentality has been rain makes grain. Now we've got some cooler temperatures. So there's just no threat to get the funds to get out of any of their shorts, is there?
Not really. And I think, maybe the quarterly or maybe the next August report where we get a little bit more of a reality check on what this yield is. I think, the report on Friday last week wasn't bad. It was, in a way, I think kind of rosy to a degree. It's showing that demand is coming up a little bit here,
right on corn.
For whatever reason. And obviously the low price story helps. But, when I look across the curve, there's really margins haven't expanded. Hog margins are pathetically low. We've seen bean oil margins bean crushing margins go up quite a bit, but, that's only going to carry the market so far in the shorter run. And you have supply, especially in corn, where high supply numbers are meeting higher supply numbers. It's not the case in soybeans where you have an inverted market up front, and that's kind of going to resolve itself over the harvest. In the corn side, it's like I have a lot of stuff, and now I'm getting more stuff, and I have to figure out what to do with that old crop. And I think you're going to see spreads widen out here, or at least that would be an easy story to sell, that, September gets weaker versus December gets weaker versus March. And, maybe even the July and December get weaker versus their 2026 contracts as more supply hits the market. And we get into that kind of full carry mode that you see in the wheat markets that have really kind of set in here.
And John, we're talking about the new crop, but we still have a lot of old crop corn yet to move, don't we?
Yeah, and that's the problem. I think, interest is an issue. Cost is an issue, as, I think many on the internet have kind of shown here that balance sheets are really low and negative in a lot of cases for folks. So, the question is, can they afford not to sell? They got to get some revenues better than none. And the cost of storage here really doesn't pay yet to put it in the bin and hedge it off of the deferreds just due to the fact that the interest rates are higher. Now, that appears to be changing. The news really du jour over the last 6 hours has been that the Federal Reserve is now looking at potentially 3 rate cuts by the end of the year. That's what's being priced in on the CME Fed Watch now. A lot of time left before that happens, but there's a cut priced in now for September, for November, and December. And that would be, I think, a little helpful tailwind to the commodities picture, which I think is really weighing on everything. This is just to sell commodities and get out of the way. We mentioned this before on the air. I said, go out and ratio a share of a contract of the S&P 500. It can be the E-mini or the big one. Just use that price and then figure out how many contracts of corn, beans, bean oil, all those markets it takes to buy one share or one contract of the S&P 500. And In 2012, it took two contracts of corn to buy one share of the S&P 500. Now corn was $8. The S&P was like right around 1,600. When things were at our lows in pre-COVID and we were trading like 320 corn, it took nine contracts of corn to buy one contract of the S&P 500. This morning, it takes 14. So even with a higher corn price, you have equities have floated higher. I will look at those as kind of a proxy for the end user. The processors of the world, the ADMs of the world who use corn for consumption. And those consumers feel maybe a little more rich here and they can come in and buy. But the problem isn't going to be solved to that. That's not going to solve the problem in the short run. The short run, we need to see supply contract either through weather problems, as you mentioned, or farmers planting less. And the problem with row crop grains is it only happens twice a year, in South America once a year, and in North America once a year. And we're starting to see estimates from Brazil that they're not cutting beans. They're going to raise more beans next year. They're being estimates per, I think SAFRA came out last week at 161. So they've gone up again. And I would imagine they're going to go up again next year. At least from the resources I have in Brazil, they tell me they're just going to plant. That's what they do. That's what they know how to do. And until something breaks, that won't change. So that's incredibly pessimistic for me, especially the deferred contracts.
Well, one market we have been pretty bullish about has been cattle. Obviously, we've had a little consolidation now off the highs. I guess the question is, with the big discount that the futures are holding to the cash, which gives? Does cash come down to meet futures, or do they meet in the middle, or what happens, John?
Well, at this point, the cutout is hanging in above 300 and some change, and that as long as that happens, I think you'll see the bid come in by the packers. The supply problems we have are well documented, and those cattle just simply aren't available. The weights are up, so that production can still maintain itself, but the margins are there, and I think they will buy. Beef demand is hanging in, and at this point, it's an interesting dynamic of people love beef. The U.S. consumer really likes beef, and that's showing itself here as you've seen poultry prices, fall to a degree. Pork prices really fall in a seasonal time. Yet the beef hang in. If the beef cutout falls, and some of the folks I work with, Steiner Consulting, they're a partner of ours or an alliance partner, and they, they're kind of thinking the cutouts rolling over a little bit here. So that would be, bearish the live. But at this point, we're still well above 180, and I look at those deferred April. That might be where you maybe look to put some hedges on, just given that that's where the market should be strongest. And if it isn't, then everything else falls, and those hedges can be applied. But right now, the market seasonally tends to be pretty well through Memorial Day. If we're going to get rate cuts, that could be a little bit of a boost to the consumer's pocketbook.
Absolutely. Hog market has bounced off of contract lows that we sent last week, but this market, do you see much upside potential for it? Because we have pretty good upfront supplies and demand maybe isn't as strong as it needs to be to get through that.
Yeah, I mean, I think if you're bullish, you just deferred those deferreds in the next year because that supply doesn't exist yet. And so, if we're going to see a solid liquidation, it's going to happen here in Q3, Q4. I think a partner of mine, Mike Rhodes, who works with a couple of big packers for us, and he noticed that we were seeing a lot of early hogs coming in. So, the supply chain was very, very current. And that might be what's, we got to that point where you saw the front months really get squeezed in the August. Now it's, we're at value territory for the packer, even with cutout where it is. So, for me, it's really how cheap can the deferreds get? And I'm speaking more December and February. Those are the months that I think could really get hammered, maybe go into the 50s. But at this point, watch China. And if Chinese can get off their feet here and start to, see prices go up, and we've seen their cash markets go up, but we haven't seen their futures go up yet. And maybe that's what we'll see. At this point, I think kind of worst case scenario is priced in. At least that's my opinion. And I think, it's pretty easy to tell folks, hey, roll down hedges, maybe buy LRP instead of using futures. And, let's see if we start to see some slaughter pick up, or you see, the sow numbers, fall. And at this point, I don't think we're seeing either happen. So it's hard to get bullish, but as I mentioned before, these are futures markets. They're going to happen before I see it. Data, if I'm waiting for data, it's going to happen before I see the data.
So true. All right. Thanks, John Payne with Advanced Trading. That is Markets Now.